Sure, yeah. So I'm Zach Jacobs. I'm a partner at Morrison Cohen. I have a broad corporate practice, but my primary focus is on public and private M&A. My goal as an M&A lawyer, of course, is to try to help my clients acquire and grow their businesses and investments, and ultimately maximize value on exit if appropriate. I've done a lot of work in healthcare and life sciences, chemicals, manufacturing, staffing, but so it's obviously a range. I'm fundamentally industry neutral. We're set up to service any industry. And so, yeah, I'm looking forward to our conversation today. Maybe my panelists can introduce themselves and tell them what brings them here. I don't know, should we start with play? Oh, you're muted there. There we go.
Thanks, Zach, for arranging this, and Marty and everyone at IvyFON as well. Glad to be here. Clay Whitehead with Plum Acquisition Corporation. We're a $320 million SPAC underwritten by Goldman Sachs with a strong operator focus. Focused on software and internet companies generally in the US and Europe in particular. In terms of personal background, I've been a venture capital investor, a company founder, and advisor to a lot of CEOs of technology companies.
Great, thanks. And how about you, Steve?
Thanks, Zach. Morning, everybody, or morning out here on the West Coast, at least. Good afternoon for the people back in New York and on the East Coast. Steve Fletcher. I am the founder and CEO of a firm called Explorer, and Explorer sponsors multiple SPACs in partnership, each time with A+ caliber former public company CEOs. We have done 5 SPAC IPOs so far. We have de-SPAC'd one, and our second one, knock on wood, will be de-SPACing next week. That one's Apex Technology Acquisition Corp merging with fantastic data management software business called AvePoint. And as I say, we have, in addition to those 2, we have 3 more that are public and searching for merger partners. And then we have a number of additional SPAC IPOs that are in our pipeline right now. We hope to do another 8 or so SPAC IPOs this year. So very, very active in the SPAC market.
Great, thanks. Irv, can you introduce yourself?
I'm Irv Schlussel. I'm the Chief Investment Officer of the Diamond Family Office based out of South Florida. We invest in both private and marketable liquid investments. My background in SPACs is more so as an ARB, just kind of buying SPACs for yield plus an option, and been doing that for quite some time, and certainly enjoying and finding the last year in SPACs to be particularly interesting.
Thanks. And Chris, how about you?
Hi, Christopher Winiarz. I serve as the Chief Investment Officer for Lakeview Capital Management. We're a single family office in Chicago. And like Irv, we've invested in the SPAC craze, although not quite at the ARB side of it, at the IPO or post-IPO. We've actually been playing it a little bit earlier in the sponsor risk equity space, and sharing in some of that equity risk with the sponsor GPs. So taking a little bit of a different approach to it.
Okay, great. And that leaves Matt.
Yeah, so Matt Tuttle. I'm the founder, Chief Investment Officer of Tuttle Capital Management. We're an ETF manager. We currently run 10 ETFs. 3 of those are in the SPAC space. We have SPCX, which is the first 100% pre-merger SPAC ETF out there. Also the largest SPAC ETF. In there, we also invest in founder shares and in pipe deals. Last month, we launched 2 de-SPAC ETFs based off of the de-SPAC index, which is an index of 25 of the largest companies coming public through a SPAC merger. It rebalances monthly and looks back a year to keep it fresh. And so one of our ETFs goes long that index, the other goes short. So we're involved on the buy side pretty much all across the SPAC spectrum.
Okay, great. So that's our panel. Thanks everyone for joining. Maybe I'll take a minute just to lay the groundwork, and then we can dive in a little deeper. Special purpose acquisition companies, SPACs, are corporations initially formed to raise money through the public capital markets via an IPO, and thereafter to use the funds raised by that IPO to acquire a business. So those are the two elements, and there's been a lot of, I would say, standardization across the market, though now as it's becoming sort of more mature in this current explosion of activity, we are seeing some evolution, and I hope we can talk about some of those new, new emerging things that we're seeing in the market as we go. So as I say, unlike a traditional IPO where you have a company with existing commercial operations, here you have an established group of investors or an institutional sponsor like an asset management firm or a PE firm who form the SPAC. And then typically, but not always, the proposed investment philosophy of the SPAC is to invest in a specific region or industry, geography, though that isn't necessarily the case. And I think, as was mentioned, you'll hear there's a lot of terminology associated with SPAC. So you'll hear SPAC or blank check companies, which refers to the fact that stockholders who are buying in are ostensibly writing a blank check to a corporation with no assets, but they believe the professionals running the corporation will be successful in identifying a target and executing. So that's really the backdrop. And in recent years, obviously the prevalence has amplified tremendously. So has media coverage and regulatory focus. So what I'd like to focus on today is really what this means for family offices, investment professionals, considering perhaps using a SPAC model for fundraising for investors in publicly traded securities, like some of the family offices might be doing, as well as for investors in private companies who perhaps are considering a SPAC transaction as a way to IPO their companies that they're invested in. And then of course, hopefully we can touch on recent developments and future outlook. So with that, let's dive in. We have Clay or Steve, each of you has a SPAC. Maybe you can walk us through the typical structure, timeline. Initially, you have the sponsors who form the SPAC itself pre-IPO, and you typically would invest a nominal amount to get your sponsor shares initially.
Sure, I'm happy to take the first cut at that, Zach, and Clay, please jump in when I go off the rails here. So, from a legal structure perspective, the way it works is the sponsor invests, Zach, as you say, a nominal amount of money to get the sponsor shares, and nominal means like $50,000 to get the sponsor shares. The sponsor invests approximately $250,000, $300,000 to get the SPAC to the point of an IPO. But it's the what is called the at-risk capital, which you need to invest to complete the IPO, and that's a real number. That's typically 2% of the IPO size plus $2 million. So if you're doing a $400 million IPO, the sponsor has to invest approximately $10 million to get the SPAC off the ground. And so to your point of nominal to get the sponsor shares, to get the sponsor shares, you invest 50 grand but they're worth zero at that point. They're not even worth the $50,000 that you put in. It's really the $10 million that you put in at-risk capital to get the company public that is worth noting. And so, at least to me, $10 million is a little more than a nominal amount. And so I think people read in the papers that SPAC sponsors invest a nominal amount to get this upside. It may be nominal relative to the sponsor promote, but it's a number of millions of dollars. It's not just a few bucks. So the sponsor then invests that, call it $10 million for, in the case of a $400 million SPAC. And the promote shares are then nominally worth, you get 10 million promote shares in that SPAC. And so those promote shares are worth $100 million. But you need to complete the acquisition to have those promote shares vest. And certainly as you're going through the negotiation with the partner company, you have to present them with a significant value proposition for them to say, yeah, I'm going to pay you $100 million to have them want to merge with you. And you also have to negotiate a transaction that people like Irv and Matt look at and say, well, that's a good transaction. I want to invest in their deal. So it's not a simple thing to do to get to the point of getting that $100 million. And there's a lot of people that are trying to claw that money away from you.
I think that's exactly right. I'd just add a couple of things. As Steve alluded to, the reward is quite juicy when you're investing early in the sponsor. There are some risks, I think, that are probably a little bit different than they've been historically, perhaps with the number of SPACs. The biggest risk, as Steve referred to, is that you don't close a deal, in which case you can lose all of your sponsor capital. And I just round numbers right now, I guess in terms of deals looking for pipes, let's say, half won't get a deal done, a quarter or so are going to have to recut their deal, and a quarter will probably go through something like that. So there's no certainty unless you bring a very high quality deal that's compelling to the market and compelling to investors abroad, that it'll get done. And then the other risk, of course, is that the sponsor negotiates away to promote. It's a competitive market out there, and I think we're seeing that high quality sponsors who are able to add value to their partner company are the ones who are most likely to retain the majority of that promote, and those perhaps who are providing more of a commodity transactional service to their partner company may be giving away more promote.
Yeah, and so just touching on that, this concept of at-risk capital, there's a few, the capital structure of the SPAC is typically in the form of, shares, but also warrants. And your experience, I assume, is that this at-risk capital is in the form of a private placement of warrants?
Yeah, you get shares and warrants, and just, I think we would think about the warrants as more upside focused, and then the shares not necessarily downside focused, but with a lot more downside protection baked into them. Yeah,
and at risk, of course, because if, as you say, a deal isn't done and the SPAC needs to be liquidated, you're not getting your money back that you've put in there, basically.
That money is gone. It is truly at risk. The investors who put up the IPO capital get their original investment back. The sponsor who puts up that at-risk capital, it's poof, it's gone.
Yeah, and for the benefit of all our participants, the money that's raised in the IPO is set aside in a trust fund, basically, and it's there, to make the acquisition, but also if things go south, to to liquidate out to the shareholders who invested. And so maybe I can bring Chris into the conversation, because I know, and you mentioned that you invest in these, the at-risk capital phase. So maybe you can walk us through how you evaluate the landscape of risk and return, how you decided to play that side instead of investing in pipes, for instance. It would be great to hear your perspective.
You'd think after a year and a half of Zoom, I'd know when to unmute myself. No, that's exactly it, right? At the at-risk capital part of the transaction, it's just a different risk and return profile. It's neither good nor bad, just different. And so when we initially started to put capital to work, to Steve's point, right, that 10 million that you're putting up, one, is truly at risk. So if a deal does not get done, that capital is spent, it's gone. So it's 100% permanent permanent loss of capital. But your upside could be meaningful. And so the risk return, think of, let's say 10x upside, 1x downside, that's a pretty good risk return trade-off. The reality is, and the team alluded to this earlier, is a lot of those promote shares do get diluted and shared. So it's not quite a 10x upside. Fair to say it's probably more 5 to 8x depending on the deal. And so if we loosely say 6x upside, 1x downside, that's still a pretty good risk return profile, but just different. Whereas at the IPO, there's also a strong risk return trade-off in that, as you pointed out, your capital is locked up in trust and you are effectively paid an interest rate on that. And you can take that back if you don't agree with the deal. But as part of that unit, you also get a portion of a warrant. And that warrant has additional value as well. And so many people we find stripping that warrant, selling that on the open market. And there's time value to that based on the volatility of it. So there's a real return associated with the warrant component as well. But when you think of your downside at the IPO, it's minimal, effectively no downside. But you could make 5, 6, 7, 8, 10% on your money on the upside, depending on the volatility of that warrant and how you trade it. That's also a pretty good risk return trade-off, but just a different one. And then lastly is on the back end, where we find a lot of people also trying to play is in a de-SPACing transaction, where a lot of these transactions require a pipe to kind of get the deal done and bridge the gap in dollars, sources, and uses. And that's a little bit easier to underwrite because you now have an identifiable company. You can look at projections and financials and say, do I want to invest in this company as you would any other publicly listed company or pipe transaction. And for us, at least, the challenge with that is when you then take into account the 20% founder shares dilution for the original sponsor, it requires a lot of, I'll say, long-term growth projections. I mean, you have to build your model out pretty far down to the double Z column to get some growth to make the numbers work. Particularly for us on the value side of the equation, we put we're pretty clearly value investors. And so it's just tough for us to make that math work with some reasonable assumptions. And so for that reason, we haven't really played at the end of the transaction on the de-SPAC of the pipe. We haven't really played at the IPO because we're looking for a little bit higher upside. And we just decided we're willing to take that risk on the front end as sponsor risk equity with some other partners. So again, all three different transactions, neither right nor wrong, just what's the right risk return profile for us or any other family office as a potential investor. And Irv, I know you've taken a slightly different approach as well, so we'd love to hear your thoughts on it.
Oh, I'm more of a liquid market trader, and I'd say you're starting to see things creep up in yield opportunity. We're not completely there yet, but there are selectively different SPACs that you can buy for, let's say, a 2-3% annualized, which isn't bad if you also have the embedded option. If you're buying just the share, not the unit. I took the point that Chris brought up about trading the warrant if you're breaking them up on the IPO is also very appealing. So it's interesting you're starting to get there. A couple of things I know. First of all, the point came up earlier about kind of the at-risk sponsor capital and that $10 million. And it's something that I think is important to note. And the particulars that I have looked at the docs, and it's important to know where does that $10 million go. It's, as somebody said, it goes poof earlier today, but who's getting that money. And it's not the IPO investors, it's mostly for banking fees. And the way that a lot of the banking fees are structured is it's split into two. So maybe they're getting that 10 million up front, and then they have a success-based extra incremental 10 million that might even be paid in shares to the bank if the SPAC and sponsor shares, if in fact that the de-SPACing is successful and there's a promote there. So the banks are incented on both sides. They get paid up front partially, and then they get paid on the back end, so to speak. And I think that kind of speaks, talks to their broader motivations. Another thing I'd point out is just the broader SPAC ecosystem and where we are today versus, let's say, 4 or 5 months ago when it was hoopla, euphoria, SPACphoria, and the average IPO was trading at $11+ the day after. I had a conversation with a sponsor, I won't say who it is, but somebody who I thought was the kind of more credible realm, let's say $300 million deal. And, my sense from talking to him is the pipes are no longer there. So he was talking to me, wearing my family office hat as a potential pipe investor. This is the type of guy that I had a lot of confidence in, who potentially I would buy his pipe, because I think he's had a number of successful deals throughout his career, and he's not just kind of a Johnny come lately to the SPAC market. But it's indicative of the fact that 2-3 months ago the pipes were being done like that because your back end view, the stock was trading at like Lumina, right? The stock was trading at 30, the pipe came at 15, or most of the pipes were coming at 10. You had a very big margin of error, even though you still had to hold till the de-SPACing. You were able to kind of bake in that buffer. So everyone was betting on the greater fool, who was the kind of retail idiot who was owning this through the back end. And that guy is completely gone. So now, as Steve said, you really have to sell the deal. And there are still a small minority of deals that are genuinely appealing and sellable. And I think as the structure changes, that might work more. But for the time being, the pipes are generally gone. So the ecosystem has shifted. So another point I'd make is, wearing my family office hat, I've seen about 3 sponsor equity deals in the past month. I don't actively seek them out. I'd probably seen one of them in the prior 2 years. So that's also a function where now you have guys trying to get IPOs over the finish line. One of them required you to commit to buying some of the IPO shares, and then they would promote their sponsor equity portion. And all of those spreadsheets that you get from people trying to sell you a piece of their sponsor equity, they presume no dilution of the sponsor equity or reduction upon the deal, which also is, as Chris pointed out, kind of a ridiculous assumption, but it's kind of a sign of the times. The fact that I'm seeing all these deals means that they're probably bad ones. So that's it.
Yeah, Irv, on that point, I'd be curious how you and Chris think about the deals that you do see, right? Because to Steve's point, on the one hand, 10 million of capital is a lot for a personal pocket, but it's also not a huge amount in the grand scheme of things. So, when this thing gets when any SPAC sponsor gets syndicated beyond the first tier of relationships, it always causes questions in my head. How do you two think about that?
I think Chris has more experience.
Yeah, no, that's a great question, Clay. I think for us, there's kind of 2 factors that we really spend a lot of time on. I'll say 3. One is, at the end of the day, it's alignment, right? My risk is, does the deal get done? And so how aligned is this sponsor alongside me to ultimately execute a deal? So for us, we only will back sponsors where they put up at least 51% of the risk capital themselves. Probably looked at 100+ sponsors out there syndicating this equity. The vast majority of them are syndicating out 70, 80, 90% of that capital. And so when we start to run through the math, we say, are they truly aligned with us? And the answer tends to be no. So our rule of thumb is they need 51% of the capital themselves. I think second for us is understanding how we as a family office add value to them, right? Why do they want our capital alongside them? Part of it for sure is, if you're doing multiple transactions or multiple, SPAC sponsorships, and they're all at scale, you start to add the math up that Steve outlined, 10 a pop on a $400 IPO, you do 3, 4, 5 of those, you run out of capital pretty quickly, even if you are a successful investor yourself. And so we're really trying to find people who kind of need that extra capital to, for that next leg of growth of their strategy. But also find the people that don't just need our capital, but want our capital. So what is it that we bring to the table as well? I'm on the family office side now, but previously I was on the institutional side. And so my colleagues are Asian sovereign wealth funds and Canadian pensions and Aussie supers and university endowments. And from that perspective, bringing them as potential investors in an IPO or the PIPE and making those introductions is valuable to them. We've now done a handful, so sharing some insights that we see into other SPAC sponsors in detail that doesn't necessarily flow through to the S1 or problems that we've seen occur with other sponsors, and sharing some of that insight that certain sponsors can't just call up a bunch of their buddies and they're not going to give them all that intel. So trying to be a very thoughtful partner to people, we've found to be pretty helpful. So really for us, it's about alignment, and that's either dollar alignment, partnership alignment, and then ultimately, how can we be helpful to people? So I think that for us has been the nuance in finding success.
Great, thanks.
Sharon.
And so it's interesting that Irv, you're seeing the pipe market dry up. I was reading some data from Morgan Stanley from 2019, 2020, and it was something like for every 100 million raised in an IPO, there was a corresponding 167 million raised in pipe. It was really, a fundamental part of sort of the equity. And I guess just for everyone's benefit, one of the drivers behind the pipe is that the stockholders can of the SPAC can have their shares redeemed out of the trust, which then reduces the amount of money available to do an acquisition. And so a lot of SPACs have used the pipe as a way to bridge that gap and replace the money that's going out the door. So yeah, it's certainly interesting if you're that signals, I think, a shift in how deals might get done.
Hey, Zach, if I can comment on the pipes,
please.
And we're seeing the same thing. So we launched SPCX in mid-December, and from the beginning, we told our counterparties that we would be interested in pipe deals, and we didn't see any. And I mean, I can tell you over the past couple of weeks, we're getting shown probably pretty much every pipe deal out there. And I mean, I'd like to think it's because we're so cool and we've gotten so big, but I've got a feeling that's probably not it, that they've sort of gone down the list and checked off the names and eventually get to us. So yeah, we're seeing the same thing.
It's kind of like back when the pipes were hot, you effectively didn't need them because the shares were trading through cash and trust, such that there's no issue rolling in or getting the full or high allocation of the cash rolling into the deal. Now they're all trading well below, not well, but moderately below, and therefore the pipe is a necessity because there's a minimum cash requirement upon the acquisition to get the deal over the finish line, and there's no takers, which means the next step is might have some empty shells.
Yeah, we were actually just shown one that we were thinking of participating in, and then they came back and said, we've decided that we don't need the pipe money anymore. We're thinking, so did you decide you didn't need it, or you realized you couldn't get it? And I'm thinking it's the latter, unfortunately.
Yeah, I think we are, though, seeing the pipe market improve, particularly in terms of number of closed deals, May to June. We're seeing an uptick for sure.
Yeah, moderate, but yeah.
And I think what people are seeing in the pipe market from an issuer or a sponsor perspective is what we saw in the beginning portion of the year, call it January, February, March, was a very exuberant market. And we've gone from white hot to ice cold. And in that time frame, sponsors could bring what I refer to as aspirational companies, a lot of pre-revenue companies, electric cars and batteries and LiDAR and space and all sorts of things that investors wanted at that time. And now the market is more discerning, the pipe market is more discerning, and you need to bring a good company, a real company at a good valuation. And people didn't need to have either of those in the January, February, March timeframe. But now we're just in a different market, and I think sponsors are realizing that. And so sponsors are going to the pipe market with less aspirational and more real companies with more realistic valuations. And I think that's going to cause the market to go from ice cold to more moderate rather than either white hot or freezing cold.
Yeah, I think that's right. I mean, I think any transaction you bring to the pipe market, you have to be thinking about why are they going to do this now rather than wait, 6 months, however long, to buy into the stock at a later period of time. So people are looking, as Steve said, for good deals, for must-have assets. They're looking for the right sizing of pipe, right? If you're the company, because you understand that there's a risk with a bigger and bigger pipe sometimes. So there's a lot of considerations from the company side, from the pipe investor side, that you as a sponsor have to balance out to have a successful transaction.
I wonder if, I guess, just looking at it from a different perspective, because we've been talking about it from the SPAC perspective and investors. I guess if you were to, this is sort of to any panelist who wants to tackle it, but if you're looking at it from the target's perspective, why do a deal with a SPAC? Why not, I guess, either stay private, in which case, I mean, I think the answer is you don't then have access to the public capital markets for future fundraising, but why not just do a traditional IPO? What's sort of in it for the target?
I'll take the first cut at that, and then everybody should feel free to jump in. So I think there are a number of structural attributes that I think the SPAC has as I say, structural advantage over an IPO. It's faster, maybe the most important one, which means if you're trying to hit a hot market, you can do that more quickly. You can show projections, at least for now, you can show projections. And you can have a deal that you have a lot more knowledge of what the value is before you go out to the market. With a lot of IPOs, you really don't know what the valuation is going to be until the night before you price the IPO. Here, I do not believe that just a negotiation between a sponsor and a partner company, and I prefer the term partner to the term target. But I don't believe that those negotiations are the be all end all of pricing, because ultimately, when you go out for a pipe, you're going to find that the market has a lot to say about what's the valuation. But you can test the market on a pipe by going to see 4, 6, 8 investors without announcing a deal publicly and finding out where the market is on valuation before you file a registration statement publicly, before you do a whole roadshow, and before you go out and air all your laundry in public. So I think those are some of the structural advantages. I also think that one of the things, and this is particularly for the growthy parts of the IPO market, and I tend to focus on technology where this is more relevant, but tech IPOs, I think the fundamental model is really flawed. And right now, tech IPOs are priced by the big banks such that they appreciate 50, 60, 80% on day one. And the issuers leave a huge amount of money on the table. Whereas with a SPAC, I think you need to bring it at a 20 to 25, maybe 30 in a really cold market % discount to get the pipe done. And so I think it's a lot less dilutive, even with the sponsor promote, to do a SPAC listing than to do an IPO. So those are the structural issues. Most importantly, what it comes down to me, is that in an IPO, when somebody sweeps up the champagne corks and the glitter from the floor the day after closing, the company is there all alone. The bankers aren't there to help them. Nobody's there to help them manage the public company. And with a SPAC, you get a sponsor team that's stock is locked up. Oftentimes there's an earnout where you're really incented to see the stock perform. But even if not, you've got some very experienced sponsors that are incented only by the stock price of the company to help it perform. And many first-time CEOs are fantastic entrepreneurs, but are not experienced public company CEOs. And this is a way to have somebody who's really in your corner to be your mentor and your Sherpa to help you create a thriving public company. And to me, it's that's the real value add. It's not the transaction, it's the partnership and the mentorship.
Yeah, and there's obviously, such a difference between being a private company and a public company in terms of, look at financial reporting and needing all the internal controls and, dealing with the markets generally. It's, I do agree that, having someone in your corner who's been there before can really help, smooth that transition. So, and so I guess one thing I don't know if we've touched on already, and maybe Irv, I know this is something you think about, but can you talk about forward purchase agreements and how those play into the structures?
Yeah, and this is just another point. There's a lot of different mechanisms that are, I won't say behind the scenes, is disclosed, but not necessarily apparent in the press releases that kind of drive the SPAC structure. And I think forward purchase agreements have become increasingly prevalent, particularly lately, given the lack of the pipe. But effectively, it is a commitment by a third party that's not the sponsor, or maybe a part of the sponsor, to participate as effectively a backstop to the pipe or to the transaction at the end to get it across the finish line. And like you saw this at the Chinchu Newburger Bourbon SPAC, and you're seeing it more. And it's kind of like in from one hand out to another, in the sense that if it's somebody who has sponsor economics or a piece of the GP of the SPAC, he's essentially agreeing to backstop the deal to get it done so that he's still able to recoup a portion of that. But I think from the bank's perspective, when the IPO is back, it's very highly thought upon, because the deal a little bit more likely to get done and a more successful for the IPO and the ultimate de-SPACing. Just to touch on your prior question about what's in it for the company, a few months ago, what was in it for them is the sponsor definitely had less of a motivation to care about the valuation at which the SPAC was getting done. He just needed to get it done and get the cash in, or the minimum cash in. So the sponsor would then proceed with the deal at whatever valuation, which means that company would get a public vehicle, and there's all the clear-cut, unambiguous benefits of the SPAC that Steve mentioned, some of which come with IPO, some of which don't. But a big element of that was being able to sell your stock at an inflated value that the market was willing to take down. I think that's less so the case now, in that the cash is not coming there. You need to do the deal at a value that's appealing enough to get the de-SPACing done. So that dynamic's changed, marginally reducing the benefit to a company to proceed with a SPAC relative to an IPO.
I'm cognizant of the time, and I'm looking in the chat, and it looks like there are some questions from the participants. So maybe Rob says he has a question. Maybe we can hear that. Okay, well, Rob, feel free to jump in. I guess there's another question here. I guess.
Hold on, Zach.
Yeah.
Can you hear me now?
Yes.
Okay, great. I did get closer. Thanks. It's good to see Marty and some of the team here at IvyFON at your offices in New York. Some of the side hallway chat's been great. It's a long time coming. My question to you all was brought up early with respect to either report risk or some of the risks associated with a transaction that doesn't go your way. How are you managing that towards more of a likelihood of a transaction, vis-a-vis a typical either private equity or venture capital raise that is advised by an investment bank or so. Are you seeing greater hit rates just given the risk of sponsor equity loss?
I'm sorry, I think there was an audio issue for me. Do you mind repeating the question?
I'll try it one more time. How are you managing for greater hit rates, just given the sponsor funds loss to this, vis-a-vis a typical type of investment banking private equity transaction? Marty, maybe you can repeat it.
So how are we managing the risk reward as sponsors? Is that the question? I'm not sure I'm following here.
Can I try and repeat what I thought the question was, which is how, as a sponsor, do we structure transactions to ensure they're going to get completed? Is that the question? Or is that not the question?
That's fine, but it's not so much ensure, but just to get a better hit rate, because you're obviously not going to get 100%, but are you getting 1/3? Are you getting 49? That's an important metric to consider.
Clay, you want to take the first cut at that?
Yeah, I'm not sure what you mean by hit rate in this context. So if you could clarify that, that would be.
You mean the dollar staying in the deal?
The dollars, the redemptions here? What?
Yeah, what percentage of the initial
People
SPAC
voting
capital?
deal.
Yeah, I mean, look, I think what's in your control, what's not within your control, and I think the things that are within your control before the IPO are lining up the right set of long-term investors who you have a track record with to invest in your IPO, who are aligned around your investment objectives and who are less likely to redeem, right? And then I think when it comes time to bring the transaction out to the pipe market, delivering on what you said you were going to deliver, having a very attractive company, having something that is at an appropriate discount, all these things factor into what redemptions you're going to see. And I think your credibility as a team is another key factor there. And I'd welcome the thoughts of Steve and others because it's a very rich topic.
Sure, I would say I certainly agree with what Clay said. I think there's all sorts of things you can do with shareholder mechanics and so forth, as Clay said. Ultimately, to me, it's really about selecting the right partner and having them have the right mindset. And so we are looking for high quality companies that will make very good public companies and looking to bring them to the market at a 20 to 30% discount. And we need to find companies that are aligned with that, right? Companies that are ready to be a public company. They can project their quarterly revenues and P&L. They have the right infrastructure in place to be a public company. They can, particularly with the help of our management teams, manage in the public markets effectively. And they appreciate that this is a first step, not the be all end all. And that whether it's an IPO or a direct listing or a SPAC listing, it's a step. It's not a sale of the company for a private equity firm. And so you've got to pick a partner company that knows that they don't want to put out a hockey stick projections. They don't want a top tick valuation. They want to come out with a transaction where it's going to be successful and where they can have a beat and raise model that is the same as another company that would be going public through a traditional IPO. And to me, as I say, I completely agree with Clay that having the right shareholder base is absolutely critical. But I think it's also critical to have the right, as a sponsor, have the right partner and have that partner have the right mindset going into the de-SPAC.
I think that's 100% right. I mean, you see there's a lot of companies that want to SPAC that aren't quite ready to SPAC. And I think it's an important job of a sponsor to to really have their screen high and be thinking about all these things. Can they beat and raise? Do they have the visibility? Do they have the forecastability? Not just to get a successful transaction done, but to continue to compound for many years to come.
One piece, I guess, touching on the sort of market trends and outlook for the future. Bill Ackman's SPAC is sort of breaking all the rules in this space, and I'm wondering the extent to which we're going to see, some of what he's doing copied. But one of the things I believe with respect to the warrants is that only a portion of the warrants are detachable from the shares, So the way the rest work is that they're basically distributed only out to the shareholders who haven't redeemed. And I wonder if we'll see that as a way to, reduce redemptions. The promise that if you don't redeem, you'll get some warrants from the people who have redeemed. So yeah, it'll be interesting to see if that's something that picks up. Of course, the other element is I think he announced his first deal, which was just a 10% minority investment in a company, and I think the way he's thinking about the structure is really to have it not as sort of a one shot and then you de-SPAC, but rather to keep it as a sort of evergreen, kind of continuing to make follow-on investments in many companies. So I'd be interested if any of the panelists have any views on the evolution of the SPAC structure and whether they expect to see more, I guess, creative structures like that, or where it's almost like a publicly traded private equity fund that's making various investments in different companies.
Yeah, I mean, I wouldn't be surprised at all. You've got right now too many SPACs chasing too few deals. We're in a copycat industry. If what he's doing works out in the end, I bet you'll see a lot of people trying to copy that structure.
We have another, it looks like there's a few questions that are touching on the same thing, which deals with, I guess there's some skepticism about conflicts of interest, and certainly the SEC came out earlier this year with some advice just on disclosures and the types of disclosures that need to be made by SPACs regarding these types of conflicts. After that, there was a bit of a flood of litigation from in New York courts primarily, probably because Delaware courts don't like settlements that just deal with disclosure as part of the settlement. But I guess what are some of the perspectives here on, I guess, conflicts of interest, aligning? I think we've talked about this a little bit already on the panel in terms of aligning the sponsors' interests with those of the stockholders in general. But if anyone wants to take a shot at that, I mean, presumably some of the sponsors out there, especially now that there are so many SPACs out there, some are better than others. But how do we see it? There's obviously a push, or perhaps there's a public perception this is a bit of the Wild West. How do you see that changing over time, and it being perceived as less less risky and less like the wool's being pulled over the eyes of the general public?
I don't know. I'll jump in. I feel like a lot of this is disclosed in the S1, and for people that don't want to read the prospectus or read the research or read disclosures or do their own research or read disclosures, then for sure there will be challenges. But I think the earlier point, there are a lot of, there is some evolution in the SPAC market where I think things will slowly become more aligned. But at the end of the day, you're still responsible for doing the research yourself and reading disclosures. And I don't think we're ever going to substitute that, no matter how strong of alignment or lack of alignment there may be. there's no substitute for doing your own research. Maybe that's the cynic point of view in me.
And there certainly are some structural elements to it as well, such as there was talk about the earnout on the target side or the partner company side, but also you're seeing the sponsor promote a lot of times now be subject to vesting. So the promote, and that's sort of voluntarily by the sponsor agreeing that they're going to subject the promote to vesting based on stock price. Of course, there are also lockups, as has been mentioned. So there are also structural provisions in place that prevent. It's not like the sponsor is basically liquidating holdings the day after the de-SPACing. That they're sort of in it for the long haul, right? One of the risks, I suppose, is that there are a lot of times, from a governance perspective, when there's a de-SPACing process, a lot of times there are voting arrangements in place and agreements about a board composition. Have any of you seen any pushback against that? The idea that boards are somewhat entrenched and the public stockholders aren't going to be able to elect directors of their choosing for some time after a de-SPACing. I don't know if that's been a focus. I haven't really seen much commentary on that aspect, but it does sort of make sense with from my perspective, with the sponsors still major holders, and certainly the partner company that is now public. A lot of the former holders are locked up too, right? They're not, and a lot of times the shares that are the merger consideration aren't registered right away. There'll be registration rights, but none of the big holders is liquidating right away. So that's interesting. Let me see. We have a minute or two left. I'm looking to see if there are any additional questions, or is there anything that our panelists see on the horizon that might be of interest to the participants here?
I would just add to your comment on boards and governance. I think one of the hottest topics is a SPAC's ability to help bring diverse board candidates and help further board diversification. It's a very frequent conversation.
Yeah, agreed.
Hi guys. Can I just jump in here? You hear me, Zach?
Yep, absolutely.
Great, thanks. We have a couple of questions from the boardroom here. I'm sorry, what was it again?
Okay, so the SEC put a 2-year on the SPAC.
A 2-year what?
2-year limit.
So the SEC has a 2-year limit on the SPACs.
That was ostensibly to protect investors.
Ostensibly to protect shareholders.
But paradoxically, it leads to
Paradoxically, it leads to overpricing of deals.
So is there any movement by the SEC to change?
Is there any movement by the SEC to change this? Zach?
Not that I'm aware of. I think so. This is the idea that if you're a blank check company, you have to make an acquisition within 24 months, essentially. I think most of the SPACs I've seen, at least recently, they're sort of finding acquisition targets well in advance of the 24-month deadline. I think, and again, as to the point about disclosure, this is disclosed, in all the S1s, that this idea that if you're coming up on 24 months, I guess there's a perception that sponsors will just be willing to do a deal with anyone for any price because, if they don't hit that deadline, then they're going to lose everything that they've put in. From my perspective, that hasn't really panned out. I understand the perspective, but I haven't really seen that in reality of sponsors trying to do a deal no matter the cost. But no, I mean, in terms of removing that 24-month time period, I haven't seen anything. I don't know if the panelists have.
I haven't heard anything about that. I think the bigger issue is that from an investor perspective, when you sell a SPAC IPO at $10, you are, at least to the event-driven investors who continue to make up 80% of the IPO books, you're basically selling a zero coupon treasury bond and a slice of a warrant to make up for that discount on the zero coupon treasury bond. And the longer the term of that zero coupon bond, the less it's worth. So you're selling for $10 a zero coupon bond that has the right to get $10, and the warrant slice has to make up for whatever discount there is there. If that's a 3-year zero coupon bond or a 5-year zero coupon bond instead of a 2-year zero coupon bond, you need more warrant coverage, and that makes it more expensive for the issuer, and that is probably less appealing to an issuer. So I think you got a market issue as well as any regulatory hurdles as well.
And as someone on the buy side, I would echo what Steve said. I mean, if you took something I was expecting to be a 2-year and made it 3, 4, or 5, we wouldn't be so happy about that.
We have another question from the audience here. Can you identify the deal before you raise the SPAC?
No. That one's pretty straightforward.
It's a big no-no.
Question in terms of projections, obviously there's a lot of chatter about guardrails being put around projections, forward-looking statements, especially all these EV. A lot of these companies are valued on terminal value, right? So what sort of
So questions about projections and guardrails around projections, especially with a lot of these EV companies, and what kind of legislation could kind of sideline the SPAC market as a result of that, at least for the more non-revenue seeking SPACs out there. Any thoughts?
I mean, I would comment, I would not be surprised to see the SEC level the playing field. So, meaning that you'd have the same rules around SPACs as IPOs. That may hurt the SPAC market, but it's not going to take away, what a couple of people I think had talked about as far as the synergies between SPAC sponsors and, and the companies they're doing deals with. So, it would take away one of the attractive things of doing a SPAC, but not everything.
Great.
Yeah, I think.
I have another question. But Zach, feel free to answer this.
No, yeah, I was just going to say, Reuters reported in April that the SEC was considering, issuing guidance on this subject, but I haven't seen anything to date yet.
What's really fascinating is that we were just in Silicon Valley last month, and a good number of the VCs that were presenting also had SPACs to kind of buy out their own firms, but maybe here nor there. It's just very interesting that the difference between the SPAC perspective in California versus here. So with that, I'm going to segue into what Pierre Dupont said, which is that he's a professional skeptic. But again, most of the people sitting here right now are skeptics. What about the Lordstown Motors issue? Have you guys, any comment on that? Lordstown Motors, described in yesterday's Wall Street Journal?
Yeah, I mean, we, in our de-SPAC funds, we own it on the long side and we own it on the short side. I think there is a huge difference between a pre-merger SPAC and a de-SPAC. And, we see a lot of news coverage saying SPACs are bad. Look at Lordstown. And it's not a SPAC, it's a de-SPAC. certainly, those shareholder sales, when they happen, why they happened, it's a public company, you got to get to the bottom of it. But, it's not really, to me, an issue if you're in pre-merger SPACs and, it's a company specific issue, doesn't really have to deal with the fact that Lordstown is a D-SPAC.
Yeah, I have a slightly different take. I think that not to disagree with anything Matt said, I think he's right, but ultimately for investors that are putting money into what I call these aspirational companies, whether they're electric vehicles or batteries or LiDAR, or space, or electric helicopters, there's dozens of companies that are going public through SPACs that are not just pre-revenue, but many years away from revenue. And these are venture bets. And 9 out of 10 of them are going to be like other venture capital backed companies, and they're going to blow up and they're going to turn into bagels. And Lordstown may well be one of those. And 1 out of 10 is going to be a home run and a half. And if you take a portfolio approach to it, you're going to be fine. If you just invest in one, it's probably a very, very risky thing. If you invested in every e-commerce company in 1999 and had a basket of e-commerce companies, as long as Amazon was in your basket, you did fine, even though the other 9 out of 10 or 19 out of 20 in your basket went away. And I think these companies are going to be very similar. When you invest in companies that are 3, 4, 5 years away from revenue, very few of them are going to work.
And I would agree with that and echo that, which is one of the